Hi everyone! Today we're looking at another tech ETF that could be a solid long-term holding. This one has earned a 5-star Morningstar rating, and over the past 10 years, it delivered an impressive 21.65% annualized return, far ahead of the S&P 500. It's the iShares US Technology ETF, ticker symbol IYW. In this video, we'll break down the investment logic behind it, compare it with the S&P 500, and see whether it's worth holding for the long run. IYW is one of the oldest tech ETFs out there. It was launched back in May 2000, right at the peak of the dot-com bubble. It's managed by BlackRock's iShares brand, the world's largest asset manager. The expense ratio is 0.39%, which is on the higher side, and that can eat into long-term returns. Assets under management are about $22.8 billion, making it a large and mature ETF. So how has it performed over the long term? If you had invested $10,000 in 2001, today you'd have more than $112,000. That's an 11-fold increase. By comparison, the same money in the S&P 500 would only have grown to about $75,000. That translates to an annualized return of 10.36% for IYW versus 8.56% for the S&P 500. In its best year, IYW gained over 65%, while the best year for the S&P 500 was only 32%. Why it outperforms? The outperformance comes from IYW's focus on large and mid-cap US tech stocks. It tracks the Russell 1000 Technology Index, which selects companies in semiconductors, software, and IT hardware from the Russell 1000. The index is market cap weighted, but with limits. No single company can be more than 22.5%. All stocks above 4.5% combined can't exceed 45%. This ensures that big names have influence, but the fund doesn't become too concentrated. Looking at the holdings, NVIDIA makes up about 17%, Microsoft 16%, Apple nearly 13%. Together, the top three account for about 45% of the fund. Other holdings like Meta and Broadcom are each under 5%. These companies are not only driving the AI revolution, but also the biggest beneficiaries. Of course, higher returns also mean higher risk. From 2001 through July 2025, IYW had 181 positive months out of 295, while the S&P 500 had 190. The worst year was 2008, when IYW dropped 43%. During the dot-com crash, it suffered a maximum drawdown of almost 70%, and it took 133 months to fully recover. In contrast, the S&P 500's worst drawdown came during the financial crisis, but it recovered in just 37 months. Even over longer holding periods, returns weren't guaranteed. Over the worst 3-year stretch, you could have lost more than 16%. Over 5 years, the worst case was a loss of 9.65%. So, long-term doesn't always mean risk-free. To sum it up, IYW does charge higher fees than some of its peers, but historically it has captured the long-term growth of the tech sector and consistently outperformed the S&P 500. It shows the potential rewards of tech investing, but also the risks, especially during bubbles like the dot-com crash. That's why it's important to always watch valuations. In today's AI boom, we should ask, are these massive investments by tech giants really turning into profits? If it's just hype without earnings, we need to stay cautious and manage our position sizes. So what do you think? Is there a bubble in tech right now? Share your thoughts in the comments, and don't forget to like and subscribe. Let's keep looking for investments worth holding for the long run.